Good evening to all of you.
Good evening.
Welcome to our class today. Last time we met, we were discussing, if I remember, I think this was a question we were discussing. Correct me in case this, sorry, let me check just a minute. I'm sure that I'm sharing the question. What's happening? Yes. Okay, the last time we were discussing, we went through a question that was asking us to get the NPV. Okay, this was the last thing we discussed last on Monday. This question was the last thing we discussed.
Yes.
Okay, fair enough. Thank you, thank you. Okay, so today, now I want us to go through the examiner. So we go through the past paper question, we see how the examiner normally sets those questions, okay? So and don't forget, this is one of the key topics, okay? With me, therefore, you can be sure there will be a question by your examiner in the main exam, okay? So let's see. So I will want to go through the question back, okay? And that's what I'm currently doing, okay? I suppose you're also doing the same. Let's see a question here. That is asking us to get an NP. Okay, let's see. Yeah, here it is. I'm sure this is a hard one of we should go deep to the hard questions. Let me see if there's a simpler question, because that one it will take you to the deep end. Replacement. I think this is a good one. Let's see. Yeah, I think this is not a bad one. November 2017. November 2017. November 2017. Question 4C. November 2017. Question 4C. Okay, so November 2017. Question 4C. Okay, so take 2 minutes to go through the question and we discuss together. November 2017, question 4C. Okay, I suppose that you have gone through the question and you have understood what the examiner required of you for that particular question. Okay, so let's go through it. So you've been asked required the initial cost, the incremental cash, operating cash flow from year 1 to year 5, terminal cash flow, okay, and the NPV, and advise the company, get the NPV and advise the company as to whether they should purchase this particular machine, okay. So the company is constantly replacing one of the bottle machine with a more efficient one. Okay, if this was to happen, then you tell that the machine is expected to economize the cost of electricity and repair cost, and to save the company $920,000 per year. So every year the company saves $920,000. So that's a benefit. That's a cash inflow. Okay. In addition, there will be reduction number of defective bottles by 120,000 annually. That's something else. That's another benefit the company will be receiving from the implementation or the use of the new machine. Okay. Then at the same time, the new machine will cost 4.7. It will have a life of 5 years. Okay. At the end of its life, that is 5 years from now, we can sell it off and get 600,000. The kind of machine can be disposed of because we don't need it, because we are going to be replacing the old machine with a new one. and you're going to be getting a value of 1060. Okay. The new machine has a current value of 2.4 million. Okay, that's the current book value, 2.4 million. It has a remaining life of 5 years, and we told that if the company was continue using the old machine, it's at the end of 5 years, that is 5 years from now, we can dispose it of and earn 200,000. Okay, and that is it. Company pays tax at 30%. The company provides depreciation on a straight line basis. That is it. Okay. I think now we can do the analysis. Year one, we just go straight. This is year one, year two, year three, year four, and year five, because the new machine has a life of 5 years. So we begin by getting the savings. Okay, you'll be told that there'll be cost of extra saving. So you can say this is a cost saving. I'll call it electricity cost saving. Cost saving, and it will be 920,000. So I'll have them in thousands, and the shillings, not dollars. So let me have them in thousands. Every year, 920 for 5 years, 920. Then you also be saving. This is defective bottle saving. I'm not sure how to call it. Let me just call it defective bottle saving. Defective bottle savings, bottles. Savings. You save 120 every year, 120 every year, 120, 120, and 120. Okay. Then, and that is it. So since, okay, those seem to be the annual savings you'll be making, and you pay tax on them, because don't forget, these are savings. That means therefore you don't need to pay tax on them. Okay, yeah. So here your total savings per year. Total savings per year will be equal to, this is 1040. Yes, every year 1040. Every year 1040. Then you pay tax at 30%. And if we told the tax at percent, we don't know when it's going to be paid. So we of course make an assumption that the tax is paid the same year. Okay. Therefore, that percent of 1040, what do you get?
312.
You get 312. Okay. So there is a cash outflow because you're paid. Every year we pay 312. Every year 312 for the 5 years. However, don't forget, the company can claim capital losses because we took that depreciation. Okay, here we assume this is tax depreciation is on a straight line basis. So therefore, the next working can be on tax savings. Therefore, next working is on tax savings. Okay, so let's do the working. Okay, so capital allowances. So first we get the capital allowances, then of course after we get the allowance, then you can get the saving. So you can begin here. Don't forget, here there are two machines. The company has two machines. It has a new one, it has the old one. Okay, so they want to replace the old one with a new one. So assuming that we continue with the old ones, let me just call this old machine. The amount the company can receive per year, we know that the new machine, okay, has a current book value of 2.4 million, and its life remaining is 5 years. Okay, so therefore we can now depreciate for over 5 years. Okay. Therefore, the tax depreciation per year, therefore, the tax depreciation per year will be equal to the NBV, which is 2.4 million, minus cost, minus its disposal value at the end of year 5, which is 20.2 million, but you're going to use it for 5 years. Okay, therefore, every year, what's the allowance? This is for the old machine.
For 40,000.
Therefore, every year we have a saving of 40,000. Okay. However, don't forget we are replacing the old one with the new one. Okay. No, let's replace it. Let's have now the new machine. New machine is cost to be told the cost of the new machine is 4.7 million. Therefore, 4.7 million. Its disposal value 5 years from now is 0.6 million. And you're going to use it for 5 years. So therefore, we spread it over for 5 years. And every year, how much can we claim for the new machine?
820,000.
820,000. Okay. Now, don't forget, since you're doing a replacement, are we going to be claiming from the KRA, for example, this for 40? Can you claim the 440? Since you're replacing the old machine with the new one, in short, you're selling off the new old machine today. Going forward, are you going to be claiming this for 40?
No.
Or it's lost. Okay, therefore, that is an opportunity that has been lost to earn. However, you'll be earning 820. Don't forget, you'll be earning the 820. Okay, which means, therefore, what's the net amount you'll be earning? Therefore, call this net capital allowance. You'll be equal to 820 minus 440. Because don't forget, you'll be earning 820, but you have lost 440. Do you get it?
Yes.
820, however, you have lost 440. Okay, using the old machine. So that's a benefit. In short, you have lost of 440 of 40,000. So it's a negative because it's a money. This you could have earned 40, but you won't be earning because now you'll be earning 820. So what's the net capital allowance therefore?
380,000.
380,000. Okay, we get 380,000. Hope that's clear. Okay, don't forget, when it comes to the analysis of the value, the cash flow, we use the concept of relevancy. Okay, since you won't be earning the 440, that's a benefit that is lost. Therefore, we quantify it. Okay, therefore the 440, therefore is for negative 440. Therefore, it is 820 minus 440. Therefore, the net capital allowances of you making the decision is 380,000. Is that clear?
Yes.
Okay. Therefore, the tax saving that is now going to be based on the net capital allowances, the tax saving, which is now based on the net capital allowances, will be 380,000 times the tax rate, which is equal to 30%. To give us a much?
114,000.
114,000 because for the tax saving to be received every year. Okay, 114,000. So therefore, you can go. Therefore, that's here the working you have done. Tax saving every year, 114,000 is a cash inflow. 114,000. Okay. There's no working capital, or is there? There's no working capital. No working capital. So what is remaining? Scrap value. Scrap value for, let me call this the new machine. At the end of the life of the new machine, we can dispose of and earn 600,000. So therefore, at the end of life, 5 from now, we earn 600,000. However, don't forget, if you had continue using the old machine, at the end of year 5, how much would you receive? If you had
200,000.
How much?
200,000.
40,000. But now, since you made the sale of this machine today, are you going to be earning that 200,000?
No.
It has been lost. That's another opportunity, benefit, loss. Therefore, old machine, you have lost the 200,000. So cash outflow equal to the scrap value of the old machine. You could have earned this 200,000, but you wouldn't be earning because you did sell off the old machine with a new one. So you'll be earning a net more or less of 400,000. 200,000 you have lost from the old machine, but you'll be gaining the 600,000. So net is 400,000. Clear?
Yes.
Yes.
Okay. No working capital, and that is it. Is it? Yeah, that is it. Okay, therefore we have here cash flow for each of the year. Year 1, year 2, year 3, year 4, year 5. Okay. Then before you do them, those are quite simple. We may want to get the initial investment cost. Okay, so let's have our next working here is the initial cost. Initial cost means therefore, as of today, how much are we going to be spending on this investment? Initial cost. Okay, Of course, we need first, okay, first is to purchase the new machine. Therefore, purchase cost of the new machine. How much do you pay for the new machine? You pay for 4.7, I guess. Yes, the new machine.
4.7, yes.
You pay 4.7 thousand. There's no working capital. You'll be investing year zero. However, now since we are replacing the new machine, the old machine with the new machine, what do you do with the old machine? What do you do today with the old machine? You have two vehicles. Okay, quote. You have two vehicles. You want to sell the new, the old one. Okay. Another. What do you do with the old one? Okay, I'll give you an answer already.
Trade it in.
Of course, definitely you're going to trade. You trade it in short. You can trade. You can sell it off. Okay. Now, in case you sell it off, how much do you receive? The old machine.
1.06 million.
You get 1.06 million. So here you have a cash inflow. Let me call this sales proceeds. Sales proceeds from the disposal of the old machine. Cash inflow 1060. Look, this is a cash inflow. This is a cash outflow. Okay. So therefore, what's the net amount you need to spend today? 3,640,000, I guess. Therefore, the amount we need to spend today, the initial cost is 3,640,000. Okay. Immaculate, ask. Yes.
Okay, just wanted to know, like, where are we getting the 1060,000, the sale proceeds, because I'm not seeing it on the question.
If you check on the third paragraph, that paragraph is made of only one sentence. The used machine current disposal value is estimated to be 1060. Can you see it?
Yes, I've seen it. I've seen it. Thank
Okay.
you.
Immaculate was.
Excuse me, Sam.
Yes, Immaculate.
A question with regard to the capital allowance. I'm wondering why are we multiplying it with the tax rate?
Why do we multiply by tax rate?
Yes.
Yeah, there are two methods you can use. If you remember that we discussed two methods you can use when it comes to getting or allowing for the allowance in the question. So you either want to subtract. I hope you still remember. Let me just take it back. They say that there are two methods you can use. Okay, we have this method which we discussed, and this is the first method here which we discussed also. Okay, so for now I'm following the first method. Okay, where you're going to be only getting the tax savings, where the savings is equal to the allowance. Okay, times the tax rate. Or you can use the second method if you prefer the second method. Okay, where you be less in the depreciation, then you add it back. Okay, so I want to follow the first method. If you want to follow the second method, no problem. You can also follow the second method. But in this question, I'm following the first method.
All right. Thank you.
Okay. But either method, either method is going to give the same answer, whether you're going to follow the first method or the second method. It's just the preference, the matter of preference. Okay, any other question?
Yes, there's a question.
Ask.
Why, okay, on the initial cost,
Initial cost.
I've not understood why it's a negative.
Because you're paying. It's a negative because you're paying. Don't forget the new machine. Do you pay for the new machine?
Yes.
That's why it's a negative because you're paying. That's why it's a negative here. Now, in the old machine, what is happening is that you're going to go to the market and sell the machine. So you get money. Therefore, that's why this is a positive.
Okay.
Yeah. So the net amount you be required to spend, therefore, is 4.7 minus 1060.
Thank you.
Okay. So the cash flow, year one, for those who have done it already. $1040 minus 312 plus
842.
842. And this applies to all the other 4 years. 842, 842. And here you get 1242. And get 1242. Okay, get 1242. Yes. The cash flow for year 5. Okay. Now we done that. We are now discount back to year 0. Okay, so present value interest factor. We discount the company cost of capital, which is 12%. 12%. Cash flow times the factor give us a present value. And the factor, we're going to get them for the tables. Okay, 0.8. So the factors from table or from the calculator, whatever alternative you prefer. 12%, 0.8929 7972 7972 all the way to year 5. Factor, the cash in the factor give us present value. So get the present value year 1, year 2, year 3, year 4, year 5. Once you have the present value, to get the NPV, sum of the present value of those cash flows you have identified.
Excuse me, sir.
Yes, yes.
What have you found as your factor
What do you mean?
for year 1?
12%?
Yes, the
29.
12%, yes.
89, 29.
89,
29.
29.
12%.
8929. Yes, 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 yes. Thank you, thank you. Yes.
Anyway, to get NPV, it's the sum present value of cash flows, which you will identify, okay, from the calculation there. Then we less the initial cost, which you have here, 3.6 million. So 3640 is a cash outflow, so it's a negative. Then that's going to give us, therefore, the NPV. When you have the NPV, you can advise the company whether to invest or not invest in the projects. Okay, so give NPV. Just multiplying and adding.
NPV is a negative.
You what do you get negative?
Negative 378.
I totally lost you, Michael.
Negative 378.
378.
Negative. Yes, yes.
Someone to confirm?
It's correct. The same.
Okay, thank you. So here the NPV of 378,000. Okay. Of course, therefore, what's the advice to give the company? The company should not replace the old machine with a new one, since if they were to do that, then of course the value of that replacement decision is a negative 378,000. Okay. The company should not replace the old machine, replace the existing machine with a new one. Since the net present value of the replacement decision is a negative, or you can even mention it, negative 378,000 Kenyan shilling. Okay, simple as that. Question? Okay, there's no question, then we can attempt another question. Let me share a question. Okay. Question asked by examiner. Let me, if I don't get that question, I'll have to share with you a question from ACCA, which actually the examiner copied from ACCA. but if I don't find it, then we'll have to do it from the HCA side. Okay, I'll do this. So there's a question. This is from June 2009, which I guess you don't have. This is June 29, June 2010, question 1B. So I bet you don't have this question. So let me just take an image of this. I share with you on our WhatsApp platform. Okay, take it out. Okay, yes, I've shared the question with you. Take 2 minutes to go through the question, then we attempt to do it together. Okay, I suppose you have gone through the question. We require to get the NPV, and of course we advise the company as to whether the machine should be purchased. Okay, we've been told that the company wants to make a product called Omega, and the quantity they'll be selling year 1, 20,000, all the way to year 5, 14,000. And so each unit the company shall be selling at a price of 100. The price is expected to increase by 10% annually thereafter. So the price for year 1 is 100. Price for year 2 will be 10% more, and every year they increase by 10%. I think we can do that. We are fast working. Okay. Here you can have workings. 19.1 we can get is we want to get the revenue, but for us to get the revenue, we actually revenue of variable cost. Okay, you can do the variable cost. Contribution, actually, you can do just the contribution. Contribution. Year 1, year 2, year 3, year 4, year 5. The contribution per unit, we told that in year 1, the selling price, no, contribution is simply selling price minus variable cost. Okay, year 1, the selling price is 100. The variable cost year 1 is how much? Is 20, and that is as per note 2. The variable cost in year 1 is 20. Then you see that this will increase, okay, by 10% because this increase in variable cost and increase in selling price is the same. Okay, so 10%. So for year 1, there's no increase. Okay, for year 1. Therefore, you multiply by the number of units we sell in year 1, 20,000 units. Year 2, it is 80, the difference. However, there's a 10% increase times, therefore, 1.1 times the number of units we're selling in year 2, 15,000 units. Year 3 will be equal to 80, 2 years later, 1.1 squared times the number of units we're selling, which is equal to 10,000 units. Year 4, 80 times 1.1 to the power of 3 times the number of units of sale, 12,000 units. Year 5, 80 times 1.1 to the power of 4 times the number of sales, number of units we're selling, 14,000 units. Okay, so get the contribution for each of the year 1 to year 5. This is one. Yes, yes.
Okay, kindly, I didn't get what how we are calculating the contribution. Like you said, it minus the multiplied by the variable cost.
No, the contribution is simply what is the cost you're incurring? What's the variable cost in per unit? In note 2, you mean the variable cost per unit is 20, isn't it?
Yes.
In note 1, you've been told that you sell for each unit for 100. So therefore is 100 minus the variable cost to give us 80.
Oh yeah, I've seen that.
Yeah, okay. That therefore, then since the increase in the selling price and the increase in variable cost is the same, you don't need to do them individually. Okay, simply get 80 times 1.1. 80 times 1.1, the power of 4. Okay.
Oh, okay, I get it.
Okay. Year one, what do you, year one, you get 1.6. Year two,
1320.
13, 20. Year three,
968.
960. Year four,
1,277,760.
760. Year five,
1,639,792.
hmm 392,000. Okay, confirm. Someone to confirm those figures.
They're correct.
Fair enough. Therefore, that's therefore makes the contribution to be earned every year from year one to year five. Okay. Then be told that fixed cost per unit per annum is 0.5 million. The company apply the straight line method of depreciation. Okay. Tax is paid at 1 year in arrears and 30%. Okay. So maybe the next working can be on the tax depreciation. Okay. That can be the next working. So working 2 is tax savings as a result of tax depreciation. Okay. Okay, so you'll be told that this machine is going to cost 5 million, okay, and we are going to incur a cost of $500,000 towards installation. At the end of its life, we're going to dispose it off and earn 1 million. Okay, therefore you can say therefore the depreciation per annum will be equal to the cost of the machine, which is $500,000. So maybe you can just have a small bucket here. There is initial cost, really initial cost here. Okay, you can call you call it machine cost. So first is the purchase cost. It's going to cost 5 million. Then you have the cost of installation. There is $500,000. Therefore, therefore the cost to bring the cost of the machine to bring it to its current state is 5.5 million. Therefore, the depreciation per annum will be equal to the cost of the machine, 5.5 million minus the disposal value. At the end of its life, that is year 5, we can dispose of and earn 1 million. Therefore, 1 million. We divide by the number of years, which is 5 years, and we get therefore 900,000. Okay. Therefore, the implied tax saving per year will be equal to 30% tax rate times the tax depreciation, 900,000, and we get therefore to 70,000. So every year the company will be saving to 70,000 as a result of the tax depreciation. It is granted to it by the tax authority. Okay. Acquisition of this machine is expected to cause a change in working capital. So next we can have working capital. So okay, 3 is on working capital. Working capital will be told will be equal to, okay, the inventory balances are expected to increase by 2 million. So inventory is going to be here, an increase of 2 million. That's for inventory. Account receivable will increase by 2.5. So receivable increase will be 2.5. Okay. Then you'll be told that payable will increase by 1.5 million. Okay. Don't forget your main to less the payable. Okay. So less payable. Okay. So the payable is going to increase by 1.5 million. So minus 1.5 million. Okay. Accrued expenses will decrease by 0.5. So less payable, less accrued expenses. Accrued expenses. Don't forget they're already negative. So we are deducting a negative. So minus will give us a plus. Okay. Therefore, 0.5 will be a plus, 0.5 million. Okay, that's for the case of accrued expenses. And the same applies for prepaid expenses. Prepaid expenses. Prepaid expenses is part of asset, isn't it? Prepayment is part of the asset. So they're part of the assets, so they're not part of liabilities. So we should not subtract them. So if anything, we need to add them here. I'm sure I'm going to squeeze it. Let me just squeeze it here. Prepayment. Prepayment to be told is going to decrease by 0.4 million. So decrease with the negative 0.4 million because this is an asset decreasing by 0.4 million. Okay, and that therefore give the net working capital to give us how much?
$3.9.
We get 3.9 million. Okay.
Yes.
So 3.9 million become therefore are you sure?
3.1.
3.1.
Yes. 3.1 million. 1 million to be the net working capital. So this is the amount the company needs to invest in year 0. Okay. What else? And that is it. Wow. Okay. Now here are the workings, so we can present our solution, our final, our NPV analysis. Okay. Call this year 1, year 2, year 3, year 4. When do you pay tax? 1 in arrears. Therefore, year 5, we also need to add year 6 for the sake of the tax. So year 1, we have contribution. And year 1 contribution, already done the working for that. 1.6. So have them in 1,000. Year 2, working for it, 1320. Year 3, 968. Year 4,
1277.
1278. That's the nearest. Year 5, 1640. Then cost, we do need to less the fixed cost. Be told that as per note 3, fixed cost is 0.5 million. Therefore, minus 500,000 every year. Though in case there was depreciation, you need to deduct it. You need to exclude it in short. Okay. If there was any depreciation, you need to exclude it. But here the examiner did not include the depreciation, so we just put as it is. Okay. Therefore, this is 1.1 net. This is equal to 820. This is equal to 468. This is equal to 778. 1140. Confirm those figures.
They're true.
Okay, fair enough. Then you pay tax. When you're paying tax at 30% per annum. Tax 30% per annum. Don't forget, in year 1 you don't pay tax because the tax is paid in arrears. Tax for year 1 is paid in year 2. So year 1 no tax payment, but the tax for year 1 is paid in year 2. Therefore, we pay much in year 2, 330.
Yes, yes, yeah.
Year 3, we pay how much?
246.
246.
Yes.
246. Year 4, we pay how much?
140.
140.
Yes, this is 468.
Year 4, 68. 140.
140.
Year 5, we pay
233.
233. Cash at 4. Year 6, we pay
342.
342. 342. Okay. That's okay. We have tax saving every year, which you got to 7,000. So every year to 7,000. But don't forget this tax saving. Therefore, it is tax based. Therefore, it is also in arrears. Okay. Therefore, can have a tax saving. Tax savings. Therefore, the saving for year 1 is being felt in year 2, and a year later. 270 cash inflow. 270, 270, 270, and 270. Okay. Then you have working capital. We invest in year 0. Okay. So here I don't have a column for year 0, but we've been told we recover working capital at the end of the machine life. So therefore, the amount of working capital we did invest in year 0, 3.1, is going to be able to be recovered at the end of machine life, which is year 5. Okay. Therefore, 3.1 million is recovered here. Year 5, is it? Yes. 3.1 cash inflow. Year 0 is a cash outflow, but it's a cash inflow in year 5. Sharon.
Kindly, I didn't understand on the calculation of the working capital, what you've done up there.
So working capital also is simply current assets minus current liability. That's what we call working capital. Therefore, we get the current assets, inventory, receivable, prepayment, minus current liability, which is payable and accrued expense. That's what I've done. is current assets minus current liability. Current assets minus current liability. We have inventory, 2 million, receivable, 2 million. Prepayment is decreasing, that's why you can see it's a negative. Payable is increasing, so therefore it's a negative because you're deducting. Accrued expenses is decreasing, therefore that's why you can see is a positive here. Because we are meant to subtract, but it is decreasing. So minus minus plus. Do you get it? It's simply current assets minus current liabilities.
Oh, yeah, okay. So
the 3 makes current assets and the 2 makes current liability.
So on the payables, okay, I'm seeing the prepayments we are adding, and then now we are subtracting, and then the accruals we are adding back.
Prepayment is an asset, isn't it?
Yeah, prepayment is an asset.
But it is decreasing. Can you see that it is decreasing? As per the question, I think they said it is decreasing, isn't it?
Yes.
Yes, that's what I said. It's a negative. For the accrual, I'll put a positive because it was meant to be deducted, and now it's decreasing. So it's like a negative, if you remember.
Yeah, it's a
negative. And then, that's why you can see there's a plus here.
Oh, okay. Yeah, I get it now. Thank you.
Okay. Okay. Okay, we are done on the working capital. Scrap value. The next thing can be the scrap value. At the end of the life machine, we are going to dispose it off and get 1 million. So you have a cash inflow of 1 million, the scrap value. Anything else remaining?
Excuse me, sir.
Yes, sure.
I don't understand that statement that says the net changing. I'm saying I don't understand how the net change in working capital will be recovered at the end of the economic life and how it's an inflow.
Okay, assume that you own, what do you sell? You sell, let's say you sell clothes, okay? And you want to close down this shop. But don't forget, you already have the stock of the clothes that you sell. Now, at the end of, if you want to close down the shop today, what do you do with the inventory you have?
You sell it.
You sell it. So, therefore, in case you sell them, what do you do? How do you get, therefore? Cash, isn't it?
Yes.
Therefore, that's why the cash inflow here. Because at the end of the life of this machine, this investment, you're going to dispose of all the working capital. So that's therefore a cash inflow. Do you get it?
Yeah, I get it.
Okay.
So in short, like that's the disposable value of the assets of the business.
Yes, the working capital, yes. The current assets, in short, yes. The current assets, yeah. Okay, that's what you can see is a cash inflow in the final year because you are recovering. So any investment you made towards inventory, towards the receivable, towards payable, you are going to be recovering for it at that point in time, 3.1 million. That's why it's a cash inflow. Okay.
Yes.
Okay. So you're done the scrap value, working capital, anything else remaining? Nothing else. Okay. So here we can have cash flow like this. Year 1, year 2, year 3, year 4, year 5. Don't forget year 6. As the cash flow, discount the back to year 0 at the company cost of capital, which we told is equal to as per note 5, it is 12%, 0.8929 all the way until the final year. Cash flow times the year is already 1100, actually. Cash flow times the present value interest factor give us the present value. So present value year 1, year 2, year 3, year 4, year 5, year 6. Once the present value, you get the sum of present value of cash flows less the initial cost less the initial cost. Initial cost we have done somewhere. Got what? It's 5.5, but we have working capital already. Don't forget the initial cost. So you can call this less machine purchase cost. Machine purchase cost, which is 5.5. You also need to deduct the working capital, the 3.1 million. Another give us the working, the NPV. Okay, so do it. And of course, we advise the company based on the NPV that we get.
Scroll up a bit, sir.
There.
Yes, yes, yes.
760.
760.
Yes,
Year 2, year 3?
negative 48.
Negative 40.
No, sorry.
192.
492.
492.
Yes.
Okay, year 4?
908.
908.
908, year 5?
5277.
5277. Year 6, negative
72.
72. Okay. Factor present value, year 1. You can ignore the decimal.
982.
982, year 3, year 2.
Yeah, 606.
Or 5.
606.
Yes.
Yes.
Yes,
Year 3,
350.
year 4,
58.
580. Year 6,
2994.
2994. And year 6,
Negative 36.
negative 36. Okay.
So I think my difference comes in at year 4. Okay, on my end I had 577.
577.
You also got 577.
Okay.
Sorry?
Yes, let me just get the first part of the table. Just multiply because this is year 4.
Year
This is
4. Yes,
so
yes.
percent year 4, 63.55. So this is
63.55 times. Yes, yes.
So now we to get 577.
Yeah.
Yes.
Okay, 577. Sum. Some of the cash flows, year 1 or to year 7.
5470.
5473.
Yes.
Yes.
After you subtract, what do you get? 3 million.
127.
127.
127, 3,127,000. Okay, 3,127,000. Okay. Therefore, we give the notice to the company. The company should not implement this project since it has a negative NPV of 3,020,001. So the company should not invest in the project or invest in the project in the machine since it has it has a negative NPV, That is it. The company should not invest in the project since it has it's a negative NPV. Okay, I see this. They're not too straight questions.
Excuse me, sir.
Sure.
Okay, not on this. I would like you to address the issue of depression again. I'm still
Issue
having
of
some depreciation. Sorry, depreciation.
depreciation.
Yes, how it affects these just a little bit. Like you can talk about it.
Okay, maybe let me try. Depreciation here, what you're assuming is that the depreciation that is given here is tax depreciation, not accounting depreciation. Because if it was accounting depreciation, okay, or if the examiner actually tells you that, hey, this is accounting depreciation, then you ignore it altogether, okay? It is not going to help you at all, either in terms of tax saving, nothing. So you can ignore it at all. In case, therefore, for example, you've been told, let's say example in note number 3, fixed cost per annum, including depreciation. Okay, I'm going through note 3. Fixed cost per annum, including accounting depreciation, are, for example, have 1 million. So if that's how that you're being given, then of course you need to adjust that fixed cost. Okay, remove that depreciation. If it's account remove it so that you only have the fixed cost without the depreciation. Okay, for example, you get 0.5 over million as it is given. Okay. Now, account depreciation, we have said that you remove it and ignore it altogether.
Yes.
However, see, what you can go ahead and assume, like for example, you made an assumption that in note number 4, the company applies the straightened method of tax depreciation. That's what you have made an assumption, okay? That in note number 4, that depreciation given to us there is tax depreciation, okay? Then we, of course, we treat it as, since this is tax depreciation, then of course we get therefore the tax saving, okay? We get therefore the annual tax saving. Michael, is that clear?
Yes, it is clear.
Okay. Daniel, another question.
Yeah.
Yes.
Why are we including the net working capital in the initial cost?
Why are we including the 3.1 million in year 0?
In the initial cost.
Because do you need to pay for the material? Daniel? Daniel, you've gone away, and I was trying to answer a question. Joseph, you have a question? You had a question. Daniel has gone away. Not sure why he has gone.
I wanted to ask the same question.
Oh, the same question. Why do you invest 3. Now the question is, Joseph, do you need to pay for the raw material?
Of course, they had been purchased.
Yes, that's why it means it's money out of the business. That's why you can say in year 0, we need to include the 3.1 million which you are paying for.
So does this mean that, excuse me, sir?
Yes, sure.
Does this mean that when calculating the NPV,
Yes.
we subtract outflow from inflow?
Outflow from inflow. I don't know. How do you outflow from inflow?
Cash outflow from cash inflow.
Cash outflow from cash inflow. Wow. Okay. Why is that sound? It sounds confusing. I'm not sure what that means. I'm here in year 0. What do you mean?
Okay, basically, from my side, I was also not understanding the logic behind subtracting the working capital. But from the brief explanation you've given, you
Yes.
said that the inventories had already been purchased.
No, what you're going to do is that in year 0, you are required to invest an extra, to put money aside and invest towards the receivable, to invest towards raw material, to invest towards the product. So if there's some money required where you need to invest to an extent of 3.1 million. So since you are investing towards your current asset, 3.1 million, therefore that's a cash outflow because you need to invest 3.1 million. Not sure I've answered the question. Joseph?
Okay, I'll digest it.
Okay. Okay, 3.1 million is money you need to invest towards your working capital. You invest money towards your raw material, or your work in progress, your finished good. You need to invest towards your customer as you'll be selling them on goods on credit. Okay, suppliers will be giving you money. Okay, so you need to get what's the net amount we need to invest towards our current and our current assets and current liabilities. So the net you need to invest in year zero is 3.1 million. But don't forget, you shall be recovering this money in the final year. Evacuate.
Could you please scroll to the right so that I could? Yeah, all right, thank you.
So that's on that question. Let's see whether we can do another question. And most of the time, the question that appear to be tough are the one that requires a replacement, where you're replacing an old machine with a new one. Those are the questions that sometimes they can cause headache. Not that they're hard questions; they are quite pretty easy questions. But I'm sure I can get that question. Someone has a question here. Okay, Joseph, you have a question? I don't know. I've seen your hands up.
Yes, sir. I was just trying to go through the working we did for November 2017. Yeah, but from my workings, I could not understand the point at which we answered question Roman 1.
Roman 1.
Yeah, Roman 1 and 2. I could not understand the point at which the questions were answered from our working.
Roman 1 was what was Roman 1 asking?
It was asking for initial net cash
flow.
Which is here. Which is here. I didn't follow the way they asked, but we have answered all the bits, but I didn't follow that exact structure. This is part A. If you had followed that. Part B, what is it asking?
B is asking of incremental cost, incremental net operating cash flow.
Okay,
so
we have
1 through 5.
We have 1 to 5. Okay, we have it here. So we have year 1, 842. Year 1, year 2, year 3, year 4. So the same here. Before, without including this. This is the terminal. This is the terminal cash flow. This is the terminal cash flow. Therefore, even in year 5, in year 6, and this is 6 or 5. Year 5 is also going to give us 842. Okay, because this is the terminal cash flow. Because I think you've been asked about the terminal cash flow, isn't it? I don't know which part, but I think it's a part.
That's Roman 3.
That's Roman 3, asking about terminal cash flow.
Yes.
Okay, now this is therefore the Roman 3 answer. Roman 4? No, this is Roman 2, terminal cash flow per each of the year. Yeah, Roman 4, what is that asking?
We are asked that using the present NPV
to get NPV
to advise management.
Yeah, this therefore Roman 4 therefore, and this is the advice we gave to the company. It's not that I didn't follow the exact structure the examiner wanted us to follow. Is it okay, Joseph? I would say it is okay.
It's okay, but now this point of incremental operating cash flow, do we now get the difference, or we just mention them as they are per year?
Do we do what? Sorry?
Do we, from the word incremental, do we get the difference?
No, just they are given. Not just there, because incremental, we are comparing the current state, which we are comparing the current state and what will be after. This is what is after. All these are incremental, all of them. They're incremental, all of them.
Okay, thanks.
Don't forget, all of them are incremental. All these are incremental because you'll be told that, for example, just to give you an example, this 920 is a saving you'll be making in case you implement. So this is an increase in the company. 120 is a saving you're making. These are tax you're paying because of the saving. So they're all incremental, don't forget. All of them are incremental. Okay.
Thank you.
Okay. So there's another question you can do here.
Malema,
Yes, sure.
could you please scroll to the workings for June 2010? I checked the year 6 working.
Year 6 working. Here.
Yes, there. Thank you.
There was a question which we had 15 years actually. There's a question we are meant to do analysis for 15 years. You get it in PV. The question I'm trying to find whether I can get it. I was asking you to get an NPV for the investment that lasts 15 years. You can get it, that would be a good one. If we can't, we do one for 10 years. So for 10 years. Yeah, and I can't find it. Ah, yeah, it is. Yes. Okay. So I've seen a question that I want us to attempt. It's from December 2009. Have time. December 2009, which you don't have with you. So I'll share the question on the forum. Okay, so let me share this question. Okay, so take 2 minutes to go through that question and we attempt to do it together. Okay, I presuppose you've gone through the question and you've had a mind map of what or how you're meant to do the question. So the following are the expected outputs for the new machine and the output that were there for the old machine. Don't forget you always use the incremental basis when it comes to this analysis. Therefore, first working can be to get what are the incremental units. And once you get the incremental unit, we get therefore what the incremental sales revenue and the incremental variable cost. Okay, so we can here first working incremental contribution per unit. Let me just call it contribution per unit. incremental contribution. Okay, so can have year 1, year 2, year 3, year 4, 5, 6, 7, 8, 9, 6 to 9, okay, 6 to 9. Oh, not sure what has happened to my pen here. So let me just cancel them out. So 6 to 9, then 6 to 10. Give me a minute. I hope it's okay now. Okay, so the next we have year 6 to 10, year 6 to 10. Then you have year 11 to year 15. So year 1, year 2, this current is the new machine, incremental. Yeah, it's okay now. So year 1, the new machine is 100 million unit minus the old machine 80 million. Then we can multiply. We will be told that in note 1, the selling price
Excuse me,
is,
sir.
yes.
We can't see your screen.
Oh, you sorry. Whoa. Thank you, Michael. This. Oh, it's okay.
Yes.
Okay. So therefore, year 1, 100 million units minus 80 million because it's about incremental. Then you multiply by in note 1, you be told that the selling price is 25, variable cost is 15, okay, and these are expected to remain constant for the 15 year. So therefore, selling price is equal to contribution is 25 minus the variable cost, which is 15. Therefore, year 1, you get how much? 200 million.
Yes.
Okay, that's year 1. Year 2, incremental will be 110 minus 80 times 10. The difference is here is 10.
300.
Give us 300. Year 3, the same process, 90 million minus 60 million times the contribution per unit, which is 10. $300 million. Year 4, 120, 60. So 120 million minus 60 million times 10 to give us 600 million. Okay. Year 5, 130, 70. 130 million minus 70 million times 10 to give us 600 million. Year 6 to year 10, don't forget it's every year. Year 6, year 7, year 8, and year 9. And then year 10 all the way to year 10. 80 million for each of the year minus 40 million times 10 to give us 400 million. every year from year 6 to year 10. Then year 11 to year 15 every year, 60 million minus 20 million times 10 to give us 400 million. Yes, the same. Oh, okay, 400 million. It was 400 million. Therefore, we have the incremental contribution. Then in note 2, annual fixed cost, excluding depreciation, okay, per year is 100 million, okay, every year for the next 15 years, okay, that's okay. Note 3, the company applies the straight line method of depreciation. We assume that the term, that is tax depreciation. If that's our next working 2 is on the tax depreciation, or what we refer to as the capital asset. Okay, therefore, we can have here, we can begin with the new old machine, and call this old machine. In the old machine, you've been told the machine was acquired 5 years ago, so it was bought, for example, in the year 2015 at a cost of 40 million. The machine originally had a life of 10 years, so at the time of purchase, its life was meant to come to an end in the year 2025. At the end of year 2025, its value was estimated to be 0. However, after the evaluation, the machine is estimated to continue all the way until the year 2035, that is 15 years later, with a Saudi value of 5 million then. Okay, if the machine was to be disposed today, the company would earn 30 million. Okay, fair enough. The old machine, can determine that under the old machine, it was bought 5 years ago. So we may want to determine currently what is its book value, what is NBV. Okay, so the net book value of this old machine, it was bought for a price of 40 million. That was cost minus minus the depreciation for those 5 years. By then, its cost was 40 million. Okay, 5 year in the year 2015, with a 0 disposal value and useful for 10 years. So we spread over for 10 years. We have used it for 5 years. Don't forget, this is depreciation per year, but you use it for already 5 years already, times 5 years. Therefore, the NBV,
$20.
yeah. $20 million. That's the kind of net book value. Because now going forward, this machine can be used for another 15 years. Okay, therefore, we call revised TD, tax depreciation, for this machine will be 20 million, the NBV. At the end of year 15, that is in the year 2035, for example, we can sell the machine off and get 5 million. So minus 5 million. We divide by the number of years, which is 15 years. And every year we get 1 million. Okay, we get 1 million. So going forward, every year, from the year 2020 to the year 2035, every year this company can claim, okay, an allowance, a TD of 1 million per year. Clear? Okay, that's for the machine. Question? Okay, a new machine. Therefore,
I have a question.
Sure.
On the NBV, when you are calculating the NBV, the 40 million is the cost which we had,
Yes.
and then the 10 million is what exactly?
The 10 million.
The one that you've divided with the 40.
It's supposed to be 10 years.
Oh, 10 years. Sorry, it's going to be 10 years, not 10 million. So it's meant to be 10 years. 10 years.
So, so it's like that is the depreciation, the 10 years.
Yes. It's 40 million
So
divided by 10. Yes. Mm-hmm.
And then the depreciation you multiply by now the number of years, like
the number of years which you have already used. We already used it for 5 years.
Okay.
Because we bought the machine, for example, 5 years ago. For example, in the year 2015, now we're in the 2020. So between year 2015 and year 2020, how much depreciation has accumulated? It's 40 million divided by 10 times 5.
Okay, I get it now.
Okay. Lillian?
Yes, I have a question on the tax depreciation. Are we multiplying by 30%?
No, this is this is not that not yet on the tax saving. This is just the tax depreciation, so not the tax saving, not yet there.
Okay, thanks.
Okay. Therefore, here we can do our new machine. The new machine has been bought for a cost of new machine has a cost of 100 million with a cost of installation of 20 million. So you may want to let me just have a small work here. Okay, cost new machine. Cost new machine is a purchase cost. Purchase cost, which is 100 million. Okay, plus the cost of installation. You be told is 20 million. Total of 120 million. Look at this, you claim allowance on the tire, 120 million. So therefore, the new machine is equal to cost is 120 million minus its disposal value in the year 2035. You'll be told that you can use it and dispose it off for how much? The year of 2035. Can you sell it to get some money? Yes. The new machine is estimated to have a useful life of 15 years and a salvage value of 30 million at the end of its useful life. 30 million is the amount you can get back. Therefore, minus 30 million. We divide by 15 years. Therefore, what's the allowance per year? $8 million.
No. Yes.
8 million. Okay,
I think it's supposed to be 6.
I think 6.
6.
Okay, 6 million. So 6 million can therefore come to the tax depreciation for the new machine. But don't forget, the same way we did before, is that since you have done the replacement of the old machine with the new one, you will not be earning this 1 million. You'll be earning the 6 million. So the 6 million, however, you have lost 1 million. Therefore, the net allowance, therefore, you'll be getting.
Excuse me, sir.
Yes.
What about the depreciation for the overhaul?
Okay, we shall do it. Yeah, we shall do it. We shall do it for sure. We shall do it.
Oh, okay.
We'll do it. Okay. So therefore, on the machine only, without the overhaul cost here, let's say the revised, the net capital allowance is equal to 6 million minus what you have lost, 1 million, to give therefore 5 million. Therefore, the implied tax saving will be equal to 5 million times the tax rate, which is 30%. It means every year we have a tax saving of 1.5 million. Okay. Then the overall cost will be told that an overall cost will be incurred in year 10 at a cost of 20 million. Okay. It is involving acquisition of a new machine, and we told that new parts will cost 20 million. Okay, now this purchase of the new parts, is it revenue or capital? Is it revenue in nature or capital in nature? This 20 million, because there'll be no overhaul to be done in year 10, is it revenue in nature or capital in nature? Is it going to increase, for example, the useful life of the asset?
Yes.
Is it going to increase the useful life of the asset or increase the asset production capacity?
I think it will increase the asset production capacity.
Let's see. Ah, yes, it may be there in note 4. Yeah, maybe we can get a hint from note 4. Go through note 4. The overall cost of the machine will be amortized. So since it is being amortized, then it is a capital investment because we don't amortize revenue expenditures. Okay, so therefore, from note 4, then we can assume that this was a capital investment, capital expenditure in short. Okay, fair enough. Okay, we can take that from note 4. Okay, so since we are amortizing, okay, in short, it's like we assume, this is an assumption you're going to make, that the amortization cost, okay, or expense is equal to the tax depreciation. That's an assumption you're going to make. Okay, therefore, the tax depreciation TD on overall cost. So here I've just made an assumption, okay, that the amortization, and the same we did with the depreciation. We assume the depreciation is tax depreciation, not accounting depreciation. So even here you can assume that this cost of amortization will also be equivalent to the tax depreciation. Okay, would be equal to, you are paid in 20 million, of course, over 5 years. Okay, it means that for every year, the amount will be amortized is equal to, don't get this particular overall cost is being incurred in year 10, and the number of years remaining is equal to 5 years. That's why I'm dividing by 5 years to give, therefore, an amortization of, or tax depreciation of 4 million. Therefore, the tax saving because of this overall cost, okay, to be earned year 11 to year 15 will be equal to the tax savings will be equal to 4 million times 30% to give, therefore, 1.2 million. So every year there will be a tax saving of 1.2 million because of the overall cost. Clear? Okay. Having done that, what else remains? Okay, do you have working capital? Working capital, the investment in the machine will also require additional investment in working capital of 40 million at the end of year 5. Working capital will be recovered at the end of the machine life, that is year 15. You're done. Okay, enough. We can do the demonstration. Year 1, year 2, year 3, 4, 5, 6 to 9. I don't want to include year 10 because year 10 there will be some extra things that we need to, like, for example, overall cost. Year 6 to year 9, year 10, year 11 to year 14. I don't want also to include year 15 because year 15 we have some extra activities occurring there. Okay. I'll begin with contribution, the incremental. Year 1, we have done the working already. Where is this? 200 million. So we'll have them in million because I may not have enough space here. So we'll have them in shillings of million. 200 million, year 1. Year 2, 300 million. So just to replicate these figures. Year 5, 600 million. Year 6 to 10, every year, year 6 to 10, 400 million, all through. 400 million, 400 million, 400 million, and 400 million. Okay, but don't forget you're also incurring fixed costs. And to that every year, we shall be incurring a fixed cost of 100 million. So cash out for 100 million every year. Then you pay tax. 100 million net, 20 million, 12 million, half a billion, Okay, pay tax at 30%, and you're paying the tax the same year, I guess, not to mention, so you assume that way. So here you pay 30, cash outflow, 60, 150, 50, 90, 90, 90, you have 90. However, you have tax savings. Tax saving from year 1 to year 10, it's 1.5 million. We have it here. Year 1 to 10 is 1.5 million. So I have to put a decimal here. You're saving too small anyway. So 1.5, 10. However, from year 11 to year 15, don't forget, we have 1.5 already, plus what you'll be earning because of the cost of overhaul, 1.2 million you'll be earning. So in short, therefore, combined wise, you'll be getting 2.7 million. That is from year 11, after the cost of overhaul, until the end of the life of the investment. They have 1.5 plus 1.2. Give us, therefore, 2.7. Is that clear? From year 11 to 15 is 2.7. The 1.5 we already have, plus the tax savings because of the overall cost which is incurred in year 10. Okay. Tax saving, then actually can include that the overall cost is a cash outflow occurring in year 10. Year 10, which is the overall was 20 million, cash outflow of 20 million. Then what else we have? Scrap value. Okay, you have two machines here. Okay. You have two machines. We have the old machine. I'll call this old machine. Don't forget, in case the old machine was to continue in production until 2035, at the end of year 2035, we can dispose it of and earn how much? 5 million. You can see that. At the end of year 15, the old machine can be disposed of and earn 5 million, but you won't be earning it because you have already disposed of. So you have lost that chance of earning the 5 million. So here, cash outflow, 5 million. The scrap value of the old machine. However, you'll be earning for the new machine. For the new machine, at the end of year 15, you can dispose it of and earn how much? 30 million. You'll be earning that million. So here you'll be earning 30 million, cash inflow, 30 million. Then from the sale of the new machine. Okay, working capital. Yes, we have working capital here. So let me just proceed. Working capital. Year 1, 2. We're investing in year 5. Where is year 5? Here it is. In year 5, the working capital investing is 40 million. So cash outflow because you're investing, you're paying. So that's a cash outflow. However, you recover in the final year. Therefore, year 15, we recover the 40 million cash inflow. And that is it. That is it. Okay. So you have cash flow.
Excuse me, sir.
Yes, sure.
How does note 5 affect us? Note 5.
Note 5. The cost of capital. We are discounting this. That's where our discount rate. The company cost of capital is our discount rate, which you shall be using to when
Yeah.
getting the present values. Okay, so you have cash flow for year 1, for year 2, year 3, year 4, year 5, year 6, all the way until year 15. Don't forget, as you can see, here you have year 6 to year 9, and you have year 11 to year 14. I hope we still remember to get the present value of until that is delayed. Okay, hope we still remember to get it. And if first get the cash flows, then I show you. Just not to show you actually, because you know, but just remind you. So first get the cash flow for each of the year from year 1 all the way to year 15. You can download the nearest. These decimal doses, they don't serve us any much interest.
Mm. 212.
Yeah, 212 in here. 212. Year 10.
No. 192.
Year 11, 14.
213.
213. And year 15, final year.
278.
278. Okay. We discount them back to year 0. The company cost of capital, which in this case is 20%. Okay, so you have the factor from the table. So I want to come in year 6 to 9. Year 6 to 9. It is. So in year 6 to 9, don't forget it's every year. Year 6, year 7, year 8, and year 9. The easiest way is simply add the discount factor from the table for each of the year. For example, the factor, okay, let me just, year 6 to 9. So year 6 to 9, let me just put an asterisk here. The factor is quite easy one, okay. It will be equal to the factor for year 6, which is equal to 20% year 6. So I'm going through the table right now, is 3349. It would be 0.3349. The factor for year 7 plus the factor for year 7, 0.2791, plus the factor for year 8, so which is 0.2326, plus the factor for year 9, so this is 6, 7, 8, 9, and 9 here is 1938, 0.938. So combine ones, how much do you want to get with the factor for those 4 years, year 6, year 7, year 8, and year 9? Or you can decide to discount them individually, but which of course is the next work for you. It doesn't make any sense. And you get?
A total of 1.0404. 1.0404.
1.0404.
Yes.
404 that way.
Yes.
Okay, fair enough. Then that's for the rate we're using here, 1.0404. All equivalent wise, okay. Don't forget this is present value and factor because it's an annuity. Because year 6, the cash for year 6, for year 7, for year 8, and for year 9 is 212. So it's an annuity. So we can this can also be given us the present value and factor year 9, 20%. Minus present value and it factor 5 year, because year 5 is not part of this. 5 years, 20%. Okay. So from the table, 20%. Look, this is an annuity, so the second table, 20% year 9 is 4.0310 minus the factor for year 5, 2.99906. What do you get?
$1.0404.
Okay, so you can choose whatever method you prefer. But don't forget that this is an annuity. Every year you have 212. Here we have every year we have 212. Year 6, year 7, year 8, and year 9. Year 10, you discount individual cash flow. The same applies for year 11 to year 14. Okay, so this is for year 6 to year 9, year 11 to year 14, same process. Present value and factor, 14 years. Present value and factor, 10 year, because 10 year is not part of it. Okay, so 20%, don't forget, 20%. So back into the table, 15 years, sorry, 14 years, 46, 06, 06 minus 20%, 10 years, 41,925. Factor you get 0.
0.4181.
4181. So that's what we're going to use therefore for year 11 to year 14. So here 0.4181, 0.4181. Okay, then for year 15, 0.15, 20%, 15 years, 0.00649. Okay, so get the present value each year. Once you have that, you get a sum, NPV, sum of present value of cash flows you're going to obtain above, V less the initial purchase, let me call the purchase cost. Purchase cost of the new machine, which we got 120 million. Was it 120? Yes, I think it was 120, if I remember. It was 120, yes, here it is, 120 million. Then, of course, we less the sales proceeds, okay? Net of sales proceeds, net sales proceeds from the new machine, old machine. And just go back to the question. The old machine, if you sell it today, you'll get how much? You'll get the old machine, in case you decide to sell today. The current disposal value of the machine is 30 million. So net 30 million. So it shows like a plus. Working capital is in year 5, so not in year 0. So you get NPV, and of course you advise the company. I'm getting how much? 8. $895.
Yes.
895 million, that is.
Yes.
Okay, that is a positive.
It's a positive.
Okay, someone to confirm?
That is the total cash flows.
Sorry?
The total cash flow.
Is 895.
Yeah.
So this is 895 million. So minus 120 plus 30.
$805.
Sorry, you got lost.
$805.
805.
Yes.
Million. Someone confirm 805 million.
Correct.
805, okay, fair enough. Therefore, get an NPV of 805 million. Okay, so since it's positive, therefore the company therefore should replace the old machine with a new one. The company should replace the existing machine with a new one, since the replacement decision has a positive NPV, Yeah, that's what you are meant to have done in that particular question. Question before we end the class? Okay, so
sure. No, I'd like to see the calculation for the initial cost.
For the initial cost. On the NPV over here?
Yes, down. Yes.
Okay, so if there's no question, then we can meet next week and we shall discuss when we shall do our cut 2. Anyway, we'll discuss next week once we meet, because once we're done a major topic, of course, we need to make a self-assessment on how we have done it. I hope by then I'll have marked your cut 1 and given it back. Okay. Okay.
How about a request?
Advice.
Is it possible we revise the cut 1 in class?
Yeah, we will. All the cuts shall be doing, we shall revise them, but we shall do that during the time for revision. Yeah, we will revise them for sure.
Okay.
Yeah, so what you can do right now is you can, once I give you back the cut, you take note of those questions which you think are tough enough, or they're tough, are worth for revision. Then during that time for revision, we are going to go through all of them. Cut 1, cut 2, cut 3, the mock. So yeah, we shall revise them for sure.
And where did you get the values which have a star?
From the working here.
Yes, up. There are some values, 0.33 plus 0.279. Yes, these values.
These values here, I got them from the tables also. So what I was trying to, or the idea was to show you that you can also get, so this, if you check your tables, the table here you want to discount individual cash flow, the first table, the factor 20% year 6. Can you check the table? 20% year 6. So what do you get?
I don't have a table.
You don't have a table? Hey, that's a disaster. I said, if you check on the question bank that I sent to you, it has a question bank, it has a table with it.
Yes.
Yeah. Also, if anyway, once we are done the class, I think you can go through the table.
Okay.
Yeah. So the tables is on the question bank that I sent to you. It's there already. But in case you're not able to it, then you can still come back to me and I'll show you. Lydia.
Yes, I have a question. Have you all the previous recorded classes on YouTube?
Yeah, I did upload. I can't remember when I did upload. I think it should be like maybe 2 weeks ago. I think like 2 weeks ago. But since then, I have not done any upload.
Okay.
Yeah, I'll do so possibly end of this week or early next week for the one for the last 2 weeks or so.
Okay, thank you.
Okay. See you and enjoy your evening.